Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call, starting a new week, an important one. Lots of news as we sort of come into this Monday morning and lots more to track over the next few trading sessions. This is Bazaar. We are coming to you from the CNBC-TV18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Surabhi and Nigel. Guys, good morning.
Hi, good morning, Prashant, and welcome back. Morning to you, Nigel, as well. So finally, the original trio is back here. And I think we wanted to ease Prashant into it, right? That's why we got him to give us a bit of a guest appearance on Friday, thanks to the Jane Street saga as well.
It was Friday, huh? Seems like so long back.
But yeah, interesting times.
And the week has just begun, so welcome back.
Actually, you know, it's proven management strategy. You should always come back on a Friday. You break in.
Ease into the reality.
Saturday and Sunday, and then you come back on Monday. So,
well, interesting times for the markets, and welcome back, Prashant. But I'm still high after last night's victory, right? India conquering England. The boys in white, young side, you know, coming out trumps. Wow. I mean, amazing. That too, we did it without Bumrah. So kudos to the boys. Quite pumped on that front, but we've got the trading cues to get to.
Absolutely. And I think we'll see if we see some fours or sixers this week, right? In terms of the markets as well. At least in terms of headlines. Markets, I'm not very sure. But in terms of headlines, will we really see some action? Now, let me just take it from the top in terms of what you need to know. So all eyes, of course, on the Trump tariff deadline, which is on the 9th of July. So when I say 9th of July, it's basically the evening of the 8th into the morning of 9th. That's essentially what you're looking at. So that's the deadline, the tariff deadline. This is the reciprocal tariffs which were first imposed. Then there was a 90-day extension which was given. Then, I mean, for many it moved to 10%. By the way, there have only been two deals struck so far. One is the UK, the other is Vietnam. You know, will that be the template? We'll see. But sources tell CNBC-TV18 that with regards to India, the final decision on India-US mini-trade deal is in the next 24 to 48 hours. I mean, actually, you only have that much time if you're to believe that this is a sacrosanct, the 9th of July is kind of a sacrosanct kind of a deadline, which I don't think it is. But before that, Treasury Secretary Besant over the weekend has said that tariffs start August 1st for countries that haven't finalized an agreement with the US. So in a way, are they already kind of starting to push the deadline out a little bit? Because, you know, and he was, I think Besant was asked this specifically, said, well, it's not an extension, but in a way it is, right? I mean, and I think that's very, very logical that the Trump administration will be pragmatic about it. And we said this earlier as well, many weeks ago, that with countries that they think they're hopeful of getting to a deal, a good deal for the US, I mean, they're not going to be hamstrung by sort of, you know, the self-imposed deadline of the 9th of July. While the deadline is important, I think, you know, there is enough leeway for deals to be struck before, but more importantly, after the 9th of July as well. So that is essentially the point. Markets anyway assume the 9th of July deadline is largely symbolic, and we've not seen any jitters at all as far as the markets are concerned based on the tariff negotiations, etc. So that's the tariff bit, which we'll sort of come back with discussions, etc. a little later. Now, two key events last week in the US, out of the US, passage of Trump's spending bill that went through, and of course the US-Vietnam deal as well, which was agreed upon. Is Vietnam really a template for other deals? I don't think so, because, you know, there is the issue of transshipment, etc., which is not relevant for many other countries. It's only kind of relevant for the ASEAN economies, Philippines, Thailand, Vietnam, etc., not for the rest of the world in that sense. Now, the S&P 500, you know, hit a new all-time high of 6279. This was on the 3rd of July. Remember, the 3rd of July was a shortened trading session in the US. That was Thursday. And, of course, 4th, both equity and bond markets were shut. But, you know, no stopping the S&P, which continues to rally hard and higher. Oil prices are slightly lower this morning. Over the weekend, OPEC has increased production by more than what was expected. So that is something to take note of. The oil prices down about 1% or so. First quarter earnings season here in India is going to be in focus as well. Expectations, mind you, are modest. I mean, you take any sector, banks, for example, which is 30% of the weight. NIMs are expected to decline over Q1 and Q2 anything between 10 and 30 basis points. So generally, it's not going to, expectations aren't for any a big banger of our earnings season at all, actually quite modest. SEBI's Jane Street order, and we'll continue to talk about this in terms of there are so many angles to this, but from a pure market standpoint, will the impact show up with regards to quieter markets, quieter volumes? I mean, you've had wild moves up and down without reason, and suddenly the screen would be on fire. Will all of that sort of start to quieten down quite a bit? And, the impact of Jane Street perhaps is the signaling impact could show up at other HFT firms, etc. as well. Jump, Citadel. There are Indian firms like Graviton, etc., etc. So, that entire segment, which has been driving market volumes in a big way, I think will be in focus. Remember, BSE was down sharply on Friday, and of course, Novama was the other one, which lost quite a bit as well. More on that a little later. So just to tie in the levels here now, I think it's going to be a little quietish as far as markets are concerned. So I don't expect any big moves, big fireworks in that sense. Support for the Nifty 25,165, which is the 20-day moving average, and the resistance, which is last week's high, which is 25,650. The Bank Nifty support is Friday's low, 56,623, and then last week's high for the Nifty Bank was 57,628. So these are very, very near-term levels, which we are working with. GIFT Nifty will give you a quick sense of how we are likely to start this morning. 23 points lower as far as the indication is concerned. Surabhi.
Yes, absolutely, because most of the Asian markets more red than green, and that's because of this whole trade uncertainty weighing on markets' minds. Now, what did Mr. Trump last say? Last, he said that he signed several letters, and he said that at least 12 at last count. And he said they will start going out on Monday. Now, who gets what tariff, what rate? That's pretty much what's bothering markets right now. In fact, if we look at Wall Street futures, because of this whole new tariff specter, even Wall Street futures are lower between about 0.25% to as much as 0.5%, depending on which market you are looking at. Now, on the India-US trade deal, like our colleague Parikshit has been reporting, the team came back from the US without any conclusive agreement. So there were no big headlines. But what he's picking up through the back channels is that this mini deal could happen maybe over today or tomorrow. And that's the hope. Now, this is going to be a mini deal. The real work on the bilateral trade agreement will only happen after the 9th. But there have been sticky issues, and we know that India's position on agriculture and dairy has been very, very firm. And not just this, let's remember the other weekend development, that India has now moved the WTO against the US on tariffs that are coming in on automobiles as well as auto components. And this is in response to the 25% ad valorem duties that the US had levied. India has basically gone to the WTO and said that these are not compliant with the GATT agreement of 1994, which is a general agreement on tariff and trade. So all is not well in paradise, but they're trying to get through the differences and get at least the mini trade agreement going. So that's the single most important point to watch. Coming to the market, it was consolidation, but consolidation with a negative bias. The Nifty ended up losing about a little over 0.5% last week, but we didn't break the lower side of the trading range. So that's the good news. The FPI flows have been patchy through the week, and we saw more of that on Friday as well. A small sell number, not very big actually, but 760 crores of selling. But even domestic institutions, at least on Friday, were on the sell side, sold off cash market stocks worth about 1,000 crores. There are lots of updates in focus, and I've just picked out 2 or 3 which the market will have its eye on. Indent Bank, we know it's going through its issues. But how deeply has it started impacting the business? And I think that's something the market will focus on, irrespective of the kind of notes that are out there. Because the advances are down about 4% year on year, 3% quarter on quarter. More importantly, the worrying point is the fall in deposits. The bank's CASA ratio has come down from 36.5% last year to just about 31.5%. So this needs to be tracked very, very carefully. A lot of FMCG updates have come, some good, some bad. Dabur, they're saying the consolidated revenue will be in low single digits because the beverage portfolio continues to hurt Dabur. There's some overall positive statements they've made as well, but that's the big headline to focus on, that the beverage portfolio is still hurting Dabur. Godrej is actually pretty okay. Godrej is saying standalone business could be delivering mid-single-digit volume growth and double-digit revenue growth at a consolidated level. So that's sounding better. Jubilant Foodworks update is actually pretty good. 17% revenue growth, like-for-like Dominos growth of over 11%. So mixed bag out there, but yes, Dabur and Indent to watch out for specifically. Nigel, what else are you tracking?
Well, on the domestic front, we'll be keeping an eye out because the earnings season does kick off. So that's going to be important. On the global front, the FOMC minutes, that's the other one that I'm going to be looking at because that will have its own repercussions with regard to flows and the fundamentals of the US market as well. And besides that, the progress on the tariffs, that's going to be the other important point. So those are the top cues on the global front that I'll be looking forward to in this week. What about Friday's trade? Well, FI participation in the cash market itself was 40% lower. Remember, the US markets were shut because of Independence Day out there. And on the back of that, you had participation that was much lower in Friday's trade. What did the FIs do in the F&O market, though? And before that, we saw a bit of a recovery from the lows of the day, both on the Nifty as well as in the Nifty Bank. And it appears for the markets on the whole, there was a bit of a short covering bounce that did take place. What did the FIs do in the F&O market? Well, they added some mild short positions, close on 5,000 short contracts on index futures. On stock futures, they added more shorts than long. So there were some shorts that were getting added into the system. But it appears even the FIs are not expecting a big fall from here on because they wrote more puts than calls in Friday's trading session, telling you that there could be some kind of a base, in the near term on the markets, and we wouldn't be looking at too deep a correction. So that's what the FIs did in the F&O markets. Moving to positioning, in the past week, the FIs, they went ahead and they added short positions. So from the start of the series, actually, the FI short positions have doubled. Just take a look at that. And even if you look at the clients, they're doing a thing of their own. Their long positions have doubled. At the start of the series, we were saying this market is missing out on some shorts, in the system. Now, that's gradually coming back. So the FI short positions at around 66,000 contracts. And in terms of percentage, well, it's more than 70% of their positions are on the short side. Moving to the options data, the 25,400 call, that had a fair bit of open interest. And you have the 25,200 put as well. There was a mix of activity with the premium at around 50 rupees or thereabouts. So which brings us to the levels. Friday's low needs to get protected. And that's going to be the important mark. You don't want that to get breached on the downside. So that 25,331 level, that's going to be important. And the bulls will want to guard that on the downside. So that's going to be an important mark. On the upside, the resistance comes in, if you take this level of around 25,400 call and you add around 175 rupees, that 25,575 is going to be the important mark in terms of a resistance level that you're looking at. Well, OPEC Plus, they went ahead and they, declared their verdict with regard to what they are planning on with regard to crude. And the amount of crude that they will be releasing into the system is going to be around 570,000. The sheet was bracing for a number of around 410,000. So the effective release of crude in the market is going to be nearly 30% higher than what was estimated. It'll keep a lid on Brent crude prices, and I'll keep an eye out on OMCs from here on. There is valuation comfort. State elections are a distance away, and crude oil prices remaining subdued is a tailwind for them. So these stocks continue to remain on my radar.
Okay, all right. So plenty of stocks to watch and, of course, the overall headlines on the tariff front as well. So let's get started. We have the equity call of the morning coming in. This one is from Chetan Sheth of Nomura, who expects markets to remain volatile into the July 9 deadline when the 90-day pause on President Trump's reciprocal tariffs expires for non-China trading partners. He says while uncertainty remains high with multiple possible scenarios, he believes that greater clarity on trade tariffs might actually help markets eventually grind higher. In general, as this could reduce one aspect of uncertainty, allowing investors to focus for now on other positive developments like the passage of the US budget, Fed rate cut theme, benign US long and bond yields, resilient US economy, and the ongoing AI narrative.
Okay, well, Mark Matthews of Bank Julius Baer and Company is with us. Mark, good to have you with us here on the program. Prashant, this side. Markets, in a way, kind of unbothered, so far at least, with regards to the tariff news flow, which was all that was singularly driving markets around Liberation Day, pre and post that. But now, not so much. What's your sense, Mark? And start with this 1st of August date which Secretary Besant put out over the weekend, saying, well, tariffs will go into effect on the 1st of August. So actually, in that sense, you have a de facto kind of extension. In any case, as I was saying, markets were kind of thinking, well, this is largely symbolic. and there will be extensions if necessary. What's your sense?
My sense is that the tariff talk is vastly exaggerated, and there's no better indicator of that than Walmart's share price, which is less than 6% away from making a new high. Walmart is obviously where all of these imported goods are sold to consumers in America. It wouldn't be 6% from an all-time high if the tariffs were going to be the kind that Donald Trump held up on his whiteboard on the 2nd of April that Besant says countries are going to get hit with on August 1st unless they do deals. So I think either that means there will be deals done in between now or then, or there'll be extensions. But one thing I would like to let you know, which I found somewhat surprising when I discovered it, but I checked and double-checked, so I believe this to be true, is that imported goods are only 10% of the consumer's basket of goods in America, goods and services, excuse me. So housing, transportation, healthcare, insurance, education, all those things have much bigger weights. And when you think about it, how often does somebody buy, I don't know, a new television, for example, or a new washing machine? It's not that often. So I think that if the oil price suddenly went up $10, that would be much more detrimental to the U.S. consumer than these tariffs. And the market seems to feel that too. So the market could get a little rocky with the tariff talk, but I think that it realizes, and rightly so, that this is vast majority of it is noise and not that impactful.
And perhaps that could be the reason, and maybe the market gets proven right. Market's been rallying through and through, despite all of the trade uncertainty, Mark. So yes, we take your point on board. So what then? I mean, if for a second we park the tariff issue aside and expect it not to be as disruptive, like you described, otherwise all indicators have been holding up. Look at the jobs report. I mean, it was ripping higher above estimates. So would you expect further highs for the U.S. market in the months ahead?
Well, typically the summer, as you know, is a time when many people are not in the market, and so it can get less liquid. And typically when things are less liquid, they can become more volatile. And historically, you don't see good returns in the summer months. But there's a number of technical indicators we can look at that do suggest the market should be higher 12 months from now. One that I can tell you is that there were 5 other years since 1950 when the S&P went down in the first quarter and then rose 10% or more in the second quarter. And in all 5 of those, 12 months later, the stock market was higher. In fact, both on a second half basis, but also in each of the quarters, the third and fourth quarters of those years, the stock market was higher. There was never a down quarter. So for whatever reason, that's quite good. And then the golden cross, which is when the 50-day moves above the 200-day moving average, that happened on the 30th of June. And it doesn't work very well for prices that are volatile. But for the S&P, it has a pretty good track record. And if we go back to the 1970s, I think there was 25 times when there was a golden cross in the S&P, and in 22 of them, it was up 12 months later. So the technicals are telling us that we should be higher 12 months from now.
All right. Hi, Mark. Good morning. Good to see you. When we've got some comments coming out from President Trump. He's indicating that there could be an additional 10% on BRICS nations, and no exceptions on that front. So India's at 10%. Another 10% would be around 20%. Do you think that's par for the course from an India market standpoint? Some were expecting a more favorable deal for India. Your view on that, and also where you see the Indian markets headed? One would argue that relatively we're expensive, but otherwise earnings are expected to pick up from year on. So your take?
Well, I can't recall ever in my career talking about the importance of imports to the United States from India for the Indian economy. I never remember that coming up in conversations. It's not a driver of the Indian economy. What drives the Indian economy is its own domestic consumption. I really wouldn't worry about it. And the Indian market is fine. I think that the the trend will remain, positive. The most important thing will be the earnings, which were disappointing last year, of course. So we need to see better earnings coming in from companies, and I think we will. I think it's a fine market, nothing the matter with it.
All right, Mark, we'll leave it there for now. Thank you very much for joining us. It's always a pleasure having you here on the program on CNBC-TV18. Thank you. Let me just quickly run you through the interactions which are lined up here over the show over the next 2.5 hours. So 8:35, we will have Amithendu Palit of the Institute of South Asian Studies at the National University of Singapore joining us to discuss the possibility of a mini trade deal between India and the US. 9 o'clock, we'll have Harshit Kapadia of Elara Capital to talk about the key trends in the defense sector. 9:20, Manish Sonthalia of MK Investment Managers will be the market master of the day today. 9:30 a.m. You'll hear from IKS's management on demand trends, what's happening in the US. Interesting space that. And of course, HAL management, DK Sunil of HAL, Hindustan Aeronautics, will be speaking with us at 9:40 on recent order wins and their FY26 outlook. A little later at 9:50 will be the IPO, which will be in focus. Travel, food services, Varun Kapoor and Vikas Kapoor join us for that towards the end of the program. It's, Economy Unpacked. Lata speaks with Sajid Chenoy of JP Morgan, Rajkiran Rai of National Bank for Financing Infrastructure and Development, Indranil Pan of Yes Bank to discuss if credit growth will grow strongly this year due to RBI's liquidity and rate cuts.
Time to slip into a short break. We've got a lot of stock-specific action to track for you. Get at that in just a bit in our special Top 10 segment. We're looking at Goodish Consumer, Jubilant Foodworks, Kalyan Jewelers and Senco Gold. They'll be reacting to positive news flow. On the flip side, you have Indent Bank, Dabur, Nykaa and Sha Metalics that will be reacting to negative news flow. You'll also have Bank of India and Borisul Renewables that could see a mixed reaction to their respective news updates.
Welcome back. So markets across Asia are, pretty cautious this morning. Some of them, like Japan, down about 0.5%. Hong Kong's also lower by about 0.5% right now. So is Taiwan. So caution as we have more clarity on what happens with trade. The implied open is telling us that we'll probably start around 20 odd points lower. Let's get the implied open back up on the screen. 40 points lower now. So yeah, this is going to be exactly at the lowest point of last week's trading range. And then we'll pick it up from there. Well, there are lots of individual stocks and important ones at that to go over with a lot of the Q1 updates pouring through. So let's straight away get to our team with the CNBC-TV18 list of top stocks to watch. I think it's going to be a toggle between Gaurav and Mangalam for the most of it today. I'll start with Gaurav. Gaurav, even I noticed Indent Bank, the fall in deposits looked, and that CASA ratio looked a little concerning. But you tell us more.
Right. When you talk about Indent Bank, we have already seen the weakness which was anticipated by the market. And when we talk about the numbers, we are seeing the weakness in the numbers as well. Now, loan book growth has slowed down almost by 4% on a year-on-year basis. And this is specifically because of the corporate loan book, where we saw a decline of around 14% on a year-on-year basis. On the deposit side, when we look at the markets and overall sentiments, the deposit was actually expected to remain stable. But now, bank has reported around 3% decline on a sequential basis in terms of deposits. This is actually led by the wholesale deposits because retail deposits have remained fairly stable on a year-on-year basis. Let's also not forget that now India Ratings has actually removed rating watch and with negative implication as a remark from Indent Bank, and they have affirmed AA+ rating with a negative outlook. So this could be a little positive for the stock today, but definitely on the back of the weak set of numbers in terms of the quarterly updates, we are watching out on Indent Bank today.
Okay, all right. Thanks a lot for that, Gaurav. Let's hop across to Mangalam. He's tracking a few of these consumer names, Dabur as well as Goodish Consumer. Mangalam, tell us more.
Well, for Dabur, it's a soft update that has come in. And the large part of this softness is because of the unseasonal rains that we saw. Their beverage portfolio not doing too well. So the company said they witnessed sequential recovery in demand with uptick in volume growth. But the beverage portfolio was impacted due to unseasonal rains and short summer. And because of that, the consolidated revenue is expected to grow in low single digits. And operating profit growth will also lag, revenue growth, which means that margins will compress this time around. No problems with the home and personal care as well as the healthcare portfolio. The company believes that revenue trend will regain momentum. So the stock opens in the red. Let's see whether it sees recovery from the lows or not. Godrej Consumer, the results tell you that the worst is behind the company. Consolidated, overall revenue seen in double digit on the back of high single digit underlying volume growth. Standalone business, which is the India business, will deliver high single digit value growth driven by mid single digit volume growth. And the volume has been strongly competitive, sequentially improving as well. What is it that has led this business? Home care business, double digit underlying volume growth, as well as personal care, which is likely to grow in low single digit. Here as well, margins are seen slightly compressing, but again, the company believes that in the second half, there would be improvement because of the lower palm oil prices. So all things point northwards for Godrej Consumer. Remember, the stock had already rallied and ended at the high point of trade on Friday. So some part of the street was expecting this sort of an update.
All right, Mangalam, thanks very much for that. Let's move on to the next one. Bank of India should be in focus, and Gaurav is here to tell us why. Gaurav, morning.
Well, yes, Bank of India, once again, we can call it as a weak quarter, and the reason being that advances growth was actually in line with what the bank had guided in the range of 12 to 13%. It came just at 12%, but on the deposit side, we are seeing this growth was at just 9%, which was guided by the bank in the range of around 11 to 20%. So that is something which is concerning at this moment, because when we look at the CD ratio as well, for Bank of India, CD ratio is a little bit higher at around 80% if we compare it with other PSU banks. So definitely this area is one of the concerns for Bank of India in terms of deposit growth. But in terms of advances, we saw decent quarter with 12% growth on a year-on-year basis.
Okay, all right. So that's Bank of India. Back to Mangalam then. I think we've got numbers from Nykaa, Dominos. I think the pizzas were selling well this quarter, Mangalam.
Pizzas sold well, as did makeup and fashion. In fact, discretionary consumption is one pack which has been doing well over the last few quarters. And that continues this time around as well. Jubilant Foodworks, consolidated revenue growth of 17%. That includes the international business as well. So standalone business of 18% is actually a shade better. And that's led by Domino's India like-for-like growth at 11.6%. So it's the third straight quarter of good like-for-like growth coming in for Domino's. And on the back of that, they've added 61 new stores as well. Total standing at 2240. Domino's Turkey, the like-for-like growth has seen a decline of 2.2%. They've opened 7 stores, so see some green on Jubilant Foodworks. Even Nykaa, remember the company has been saying that the fashion business is likely to break even this year. Out there, the overall revenue will be at the lower end of mid-20s. Not particularly bad in a sector which is not growing as much. The beauty business will actually show mid-20s sort of net revenue growth. Gross merchandise value expected to be higher, crossing mid-20s. And fashion vertical, net revenue expected to improve sequentially to mid-teens. And that is a good performance after many quarters of weakness that we've seen in the fashion industry. So that's where I expect some green on Nykaa. The stock was slightly under pressure on Friday's trading session.
Okay. All right, Mangalam, but you have tracking more updates. Kalyan and Senco as well. Tell us more.
Good performance coming from the jewelry companies as well. I'll await Titan shortly, but for Kalyan and Senco, look at Kalyan. Consolidated revenue growth of 31%. The whisper on the street was close to around 30%, so it's better than that. Demand, they say, has been driven by robust performance in Akshaya Tritiya as well as the wedding season. Same-store sales growth for Kalyan Jewelers coming in at 18%. Middle East, the revenue grew at 26%, and the digital-first platform, basically the carrot lane version of Kalyan, which is Candier, grew around 67%. They've launched 10 showrooms in India, 1 in the US, and 8 Candier showrooms in India. Senco as well. The company said, for this entire year, they're looking at 18 to 19% growth. The first quarter itself, they've done 28% growth, retail revenue 24%, and 19% same-store sales growth. Out here as well, the diamond jewelry volume growth came in at 35%, implying that the studded ratio was maintained. That's positive for the margins. They've opened 4 new company-owned outlets and 5 new franchise-owned outlets. Remember, the second quarter is seasonally weak for jewelry companies. But here as well, you do have Raksha Bandhan and Onam, which will see consumer demand, improving. But more importantly, I'll be watching out for this underlying trend of consumers looking at 14 and 18 karat gold jewelry at a time when gold prices are so high. So these would be margin accretive for these companies.
Okay, all right, Mangalam, thanks a lot for that. Well, I'm looking at Sha Metalics. They came out with their quarterly update. It's not a big mover, actually, for none of these companies. It's a big mover, but we're just highlighting it since it did come out, and they look a little bit softish, and since it's monsoon season, going with a tinge of red. Well, specialty alloys, it was a little bit higher on a sequential basis. The realizations were a little bit lower. While for the other products, actually, they flipped it around. Stainless steel volumes, so that was down by close to 18% on a quarter-to-quarter basis. But you did have that the realizations were a little bit higher. And on aluminium foils as well, there as well, volumes a little bit low by around 3%, but realizations were higher on that front as well. So maybe a tinge of red on this one, though, as I mentioned, not a big mover for the stock. Vivek joins in, though, to tell us about Borisul renewables. Hey, morning, Vivek.
Good morning. Well, decisive action taken as far as Borisul Renewables is concerned. This is regarding the European operations and the subsidiary that is known as GmbH. So what's actually transpired is that the company has gone ahead and the German subsidiary GmbH has filed for bankruptcy at the German insolvency court. What the company was facing as far as European operations were concerned were very similar to what the Indian operations were facing. Chinese dumping actually going ahead and reducing the demand for German-owned manufacturing. Remember, since January, the furnace has been cooled down due to demand paucity as well as depleted market conditions. What will be the financial impact? The company says the exposure to the German subsidiary is close to 350 crore. They were making a cash loss of close to 9 crore rupees a month, and that is something that will stop effective immediately. Along with that, the company says expenses and cash flow of GMB will now be managed by the insolvency administrator. Just to give some perspective, this was a material subsidiary. 22% of the total top line of FY25 actually came in from this particular subsidiary, but it was loss-making at the EBITDA and PAT level.
Okay, so maybe the insolvency at least starts, putting things in motion, some sort of logical conclusion. Thank you for that, Vivek. Let's quickly recap our list of top stocks to watch. The ones that have positive news flow would be Goodish Consumer, Jubilant FoodWorks, Kalyan Jewelers, Senco Gold and Nykaa. The ones with negative news flow would be Indent Bank, Dabur and Sha Metalics. Bank of India and Borisul Renewables could see a mixed reaction depending on the news. That's our stock list for the morning. Let's do a roundup of all the commodity market action as well. We have Manisha Gupta joining in. Manisha, morning. It's going to be those tariff and trade headlines that will dominate the market's mood. But you tell us, there's also the OPEC meeting. So what's top of mind?
Oh, well, absolutely. I'll start with the OPEC meeting first. And OPEC Plus has accelerated production hikes, citing stable economy and low oil inventory. So you have a number which is much higher than what we were dealing with for the month of May, June and July. So versus the 411,000 barrels per day, you have it at 548,000 barrels per day. The street was absolutely not anticipating that. There was no chance of this number coming in. And that is the reason we've seen the crude oil prices react the way they have. And as you mentioned, it also is going to be about the U.S. tariffs that will take effect from 1st of August. Let us go into how many countries with what tariffs is something that the street will watch on. And then it also has to do with the weak China services activity. That seems to be weighing on many of these commodities. So it's not just the crude oil prices which have started the day on a weaker note. You have rubber prices declining because of the fall in crude prices. Even the gold prices have seen a decline after that weekly gain of 2% in the previous week. Silver is trading lower. Copper, aluminum also have seen a bit of a decline. So hardly any commodity which is trading in the positive at this point in time. We've started Asia slightly jittery.
Okay. All right, Manisha, got it. Thanks for that quick wrap up. Well, now let's revisit, of course, the big story on trade, what impacts us and where we're positioned with respect to our conversations with the U.S. We have Parikshit joining in. Parikshit, we know that the Indian delegation, the Indian team, I guess, came back from the U.S. But you tell us, because you've been reporting that there could be some sort of maybe an interim or a mini trade agreement. Is that right?
What we're looking at right now is only an early harvest agreement before the 9th of July. The negotiations on the larger BTA or even the first tranche of the bilateral trade agreement will only begin after the 9th of July. And that's going to be signed during President Trump's visit to India during fall. So what we're hearing right now is that negotiations on that mini trade deal or that early harvest deal are over. Our negotiators have returned. There's no more talking to be done. The ball really now is in President Trump's court, the White House court, and they have to take a call. From the Indian side, we've proposed a fair deal, which would give good market access to India's labor-intensive sectors and MSMEs as well. We've drawn our red lines. India has refused to grant any concessions on core sensitive areas such as wheat, rice, maize, dairy, GMO crops. India has refused to give any kind of market access in these areas. So given that, let's see if President Trump and the White House accepts India's proposal as well. There could be certain agricultural items which are not used in India extensively, like pecan nuts, blueberries. These could be allowed access. As far as automobiles are concerned, we believe from sources that India has offered the same sort of concessions that it has offered to other nations, including UK and European Union in talks. So nothing different. India has made the point that whatever we've offered in terms of automobile tariffs to other nations, such as a reduced tariff of 10% on certain category of high-end vehicles or electric vehicles as per a quota system, only that is going to be given. We're also learning that in case this deal happens, there will be a mix of both quotas and tariffs. So, for example, India's labor-intensive products, such as textiles and footwear, they could be subject to quotas for a lower tariff, maybe 0% or 2% for a certain number of items for annually, and beyond that, a higher tariff would be imposed. So let's see what kind of contours the deal takes and whether President Trump and Prime Minister Modi even sign off on the deal.
Okay, all right, Parikshit, thank you very much for that. That's an important story for the markets, but of course for the economy as well. We'll continue to get you latest updates on that. We'll take a quick commercial break here. More on the India-US trade talks, and we take some of that forward with Amithendu Palit of Institute of South Asian Studies at the National University of Singapore, coming up in just a bit.
Welcome back. So the big global headline is what happens next on tariffs. And, from our context, whether we can get at least some sort of an interim or a mini trade agreement, as Parikshit was just telling us. So let's discuss this forward and India's positioning and stance. Amithendu Palit, Senior Research Fellow at the Institute of South Asian Studies at the National University of Singapore, is with us now. Mr. Palit, thanks very much for joining in. And I don't know if you could listen in to our colleague, but a brief summary for you. What we're picking up from our sources is that big bilateral trade agreement, perhaps those discussions will continue. There might be a small, interim deal, but there are sticky issues, and agriculture and dairy, and the US is thrust to ask for total market access, including GM crops. These continue to be sticky grounds. Your first thoughts on how things stand?
Firstly, Subhi, Prashant, Nigel, great to see all of you guys again. Thank you very much for calling me on the show. This was expected in the sense that if we look back at the timeline of events, when Prime Minister Modi visited the US in February, there was confirmation about the fact that India and the US would negotiate a bilateral trade agreement. The reciprocal tariffs came later. And in the first announcement between PM Modi and Trump, the idea was that a deal will be concluded by the fall of the current year. Now, the reciprocal tariffs, when they were announced on April 9 and then subsequently paused, brought forward the timeline to that 90-day period. 90-day period, and for the United States, it's dealing with some 90, 100 countries at the same time. I think it was impossible under any circumstances to expect that by that period of time, there will be a comprehensive trade deal worked out. So what we are very likely to see is at what you have shared, and I think what Parikshit also mentioned, there's basically going to be a list of items which will be identified on the basis of the tariff rates that have been agreed upon by both sides. There will be negative lists cut out from both of these. On India's side, the concerns have been very well mentioned. On the other side, I'm not sure whether India has been given access over and above what its other competitor partners are going to get in the US economy. Because looking back at what has happened with Vietnam, Vietnam's tariffs are getting a 20% deal, which is not too different from the 26%. And there's a transshipment of 40%. So these are all very vague and gray areas to be worked out. But Subhi, if you could allow me to say that, my anxiety on this is that once you have a deal agreed upon by both sides, there's not going to be any giving up by the US in order to continue to extract market access concessions. And that is where I feel that the US focus will now shift to non-tariff approaches for extracting market concession.
But Mr. Palit, Mr. Palit, sorry, before we come to the non-tariff barriers, and that's something that the US has been highlighting, time and again. Before we talk about that, on tariffs itself, let's also place on the table what's been happening simultaneously. We have moved the WTO on several issues already, in the last 2 odd months, including the latest salvo being on auto tariffs. the 25% ad valorem auto tariff. So there is that simultaneous process going on where India is going ahead and registering, so to speak, its protest while it's negotiating, trying to negotiate a bilateral agreement. So how do we tie in the two?
Problem, Subi, is that most of the other tariffs, the generic ones, steel, aluminium, auto, the US is bringing in under a section called 232, where it is advancing the national security considerations and the fact that they need to be sorted out on those grounds. What is happening between India and the US separately, like the US and many other countries, is a separate FTA. I think this is exactly where what you mentioned is going to become important. India would want those other generic tariffs not to be imposed on it under the ambit of the FTA. Now, whether the US will agree to that or not depends on what India is offering. So I'm not too sure whether an equivalence will be established there.
Got that. Mr. Palathai, good morning. Prashant here.
Good morning.
So, good to see you again. In the very near term, then when we talk about this mini deal, right, could we basically look at, for the sake of argument, like a 2-page document which kind of agrees on, which keeps the existing tariffs in place but pushes many things down the road and for later in that sense. Is that what we're looking at in the near term?
Prashant, we might not even see a document at all in the first place. What we might just see is a convergence of interests, a declaration coming out from both sides that the US and India have agreed to do so and so in the first round with, negotiations to continue. Now, what I think is important to take note is that the United States is doing this with not just India, but a number of other countries. Even if you look at what they finalized with the UK a couple of months ago, was something very similar. Just an expression of interest that do a little bit here, do a little bit there. Whatever India has already done autonomously in the last union budget, reduced the number of duties, anticipating that there will be US pressures. I don't really expect there will be too much over and above that, at least in those sectors where India is keen on guarding its market. I don't see that is going to happen. But again, as I was sharing with Subi, I think my concern is over the fact that what kind of pressures you might expect from the United States through other policies now, including monetary policies, exchange rate management policies, which might be a way of getting more concessions under the belt.
Could you just very briefly detail, one is the foreign exchange route, could you detail sort of 2 or 3 of these routes through which more pressure could be put that you're worried about?
My first concern over is the quality control measures that India has for a number of exports, on which the United States has already mentioned in its foreign trade barriers report that these are very ad hoc and arbitrary. They might want these to be taken out. But more importantly, Prashant, you will recall that the United States has been very sensitive to any efforts which they think is contributing to de-dollarization. Now, the Indian position on this has been pretty much clear in the sense that while not going for de-dollarization, India would want to trade that much more in other currencies, including its own currency. There are groups like the BRICS, where it continues to play an important role for encouraging interoperability of currencies. And the BRICS is on the quote-unquote hit list of the USTR of a large, a gamut of tariffs. I think the pressure will basically now come on India to maintain its foreign exchange rate management policies in such a way that the dollar does not lose its place of prime in any respect.
Okay, so these things have an interplay, and now how India sort of deals with that sort of a pressure. We've had an absolute hands-off approach in terms of exchange rate management, driven only by the country's interests. So we'll have to see how this plays out. Thank you very much. Short chat.
You're welcome.
But I think there'll be several ahead as we understand the final realities and the granularities of the India-US trade agreement. By the way, Prashant, when you were saying what will be the format of this mini deal,
I'm very interested in the format.
Could it be the two-pager? What's the image that came to my mind? Remember President Trump holding up his placard? Maybe Prime Minister Modi holding up his, saying, hey, this is what we're giving you.
Well, I don't think we'll see theatrics like that by Prime Minister Modi.
Unfortunately.
But, I think kicking the can down the road on many things, and maybe just like a broad structure. And as Mr. Palit said, maybe not even a two-page document, maybe just sort of some sort of a understanding that, well, this is what we need to do, and this is where this is what we are in agreement with in that sense. We'll see. We don't have to wait very long, as sources were telling Parikshit that over the next 24 to 48 hours, a final decision will be made on whether to sort of, go ahead with that sort of mini deal, if they have that mini trade deal or not. I think Prakash Diwan is with us with what, he's making of things. Prakash, good morning. Great to have you with us here. From a market standpoint, I mean, I was making this point earlier, unless very disruptive, markets are largely unbothered. But what's your sense if you were to kind of sort of pick a sector or two where this will show up and you could see some price moves? I'm talking about the tariffs.
Good morning, Prashant. You're right. I think we could keep discussing what could happen on the tariffs till the cows come home, but the markets will do their own bit. And remember, you just have a few days before the result season starts to kind of emerge, and the market will kind of get to be enslaved with that. From the tariff potential disruption perspective, I think if nothing happens on auto ancillaries, that's an area that could kind of, there's been a lid on most prices, most price volume action, and that could kind of change. We saw how, some of the local triggers for Bosch and all, Gabriel, was kind of playing out last week. And that could kind of, percolate to a wider basket of auto ads. That's one area. The other thing which has not been discussed when we talk about tariffs in the same breath is a pharma pack. There was likelihood that there could be some restrictions on pharma companies which haven't come about. Now, if there's some emergence of that, you'll probably see a little bit of softness there. But by and large, I think the market will continue to march ahead on the anticipation of improvement in numbers. The June quarter updates, while they might be a mixed bag for the banking sector, for example, but some of the gold jewelry companies, some of the FMCG plays, they have started kind of giving some sort of a promise. And if that were to happen, you'll probably see a very strong sector rotation as well, because there are sectors which have still not kind of participated in this up move in the last 2 months. And my sense is the market will probably look for opportunities there.
Okay. Prakash, hi, morning. Good to have you on. Indent Bank. So we all know, actually let's pull up the long-term chart as well on the Indent saga. The thing is that the business is getting impacted with all of this, and that's what the stock has done. Let's pull up an even longer chart. Yeah, that's 3 months. Now this is the issue. The stock has continued to rally, and then you get an update which is giving you the harsh reality that all the ongoings of the last couple of months, they're impacting the business, not just advance growth, but look at the CASA ratio. It's fallen 500 basis points in the last 1 year. Your thoughts?
Good morning, Surbi. So this is quite understandable. We've had a fallout which has been fairly drastic in terms of what impact it has. And the ship has been rudderless of sorts for the last many months. So it's no surprise that some of the metrics will start deteriorating. But what's interesting is that the market is penciling in a hope trade here, that nothing more could go wrong. There's not much of worse news flow that could hit the stock. And whatever happens is going to be incrementally positive, right? So that's the reason why the short-term moves probably look a bit deceptive. But as I told you last time, these things need much more effort, time, resources to repair. We've seen how Yes Bank took so long to really come into the reckoning, where a suitor started wanting to look at it. So I think Indent will also have to go through that grind. Don't expect fireworks just because some new CEO gets appointed. I mean, you will have to have a CEO, right? But it won't make such a big difference till the organic improvement happens. So not something which I really like, especially when you have much more promising plays in the same space available, in the same size available. So I would give it a pass.
All right. Hi, Prakash. Good morning. Good to see you in. Prakash, what's the view on Goodish Consumer? In the last few weeks, you're suddenly hearing about positive sentiment on consumer stocks because the street is bracing for a far better year in the second half of the year. Now, Goodish Consumer, their quarter one update itself is a little better than what the street was working with. I'm reading a note coming in from Nuvama. They are saying that they're expecting the gradual recovery from year on. The numbers are a beat. What's your view on the stock?
Good morning, Nigel. No, so absolutely. As I was mentioning to Prashant earlier, that some of the early signs from the June end, updates are looking very positive from a demand revival perspective. Okay, Dabur probably has it, worse off because of the early monsoon, because they have a beverage portfolio which is significantly active and large. But that's not the case with the Marico, Britannia, HUL, even Godrej. So what it does is that if the monsoon is early and widespread and is adequate enough for this timeline, it sets a base for a much longer, much stronger festive season or post-harvest season, right? And that's exactly what most FMCG companies badly need. The other thing that's very interesting is that we've not had any raw material disruptions in terms of price hikes, in terms of grammage reductions, all of those related things which we saw 18 months back. So the companies have digested all of that, tightened the belts, they've learned to live with the realities of poor demand or tepid demand. And now I think the margin improvement will be fairly smarter than what we expect. The volume growth will take some time to come, as I said, post-monsoon, but the margin improvement will be fairly sharper. And that's exactly what will start getting worked onto the prices. My sense is FMCG is not performed from a sector rotation perspective, especially the larger ones. We'll probably see a lot of money getting allocated to it over the next couple of months.
Absolutely. FMCG, consumer. So that's a space to take note of. We'll talk more about this. Prakash, stay with us. What we're going to do is take a quick commercial break here. 8 minutes to pre-open session. Chandan Taparia and Mitesh Thakkar will be with us with some technical trading ideas coming up.
Welcome back. Well, as promised, we have our technical experts, Chandan Taparia as well as Mitesh Thakkar, who join us for a technical check on the markets. Good morning, gentlemen. Mitesh, you go first. In Friday's trading session, we went down to around the 25,330 mark, and we saw a good bounce from there. What's your view on the markets from here on? Do you think we have more to go on the upside? The problem is there's still plenty of uncertainty on the trade front.
Morning, Nelly. So my understanding is that in the immediate term, the upsides will be capped. Getting past 25, 650, 700 zone would be difficult. And having said that, I think good chance that we'll see some consolidation in which the markets could either decline to 25,400, which we have already done, and even to about 25,200. So I think preparing that, there is a chance of us possibly testing 25,200. Only beyond that, if we start declining, below these levels, then we'll be worried about the trend in force.
Got that, gentlemen. Morning, and good to see you both. Chandan, you go next. What's the call and what's the overall view from here?
Yeah, good morning, Prashant and Nigel. Thanks for having me. So we witnessed some profit booking decline in last 3-4 trading session as index has been making lower top, lower bottom on the daily chart. But major trend is intact to positive as we have seen a decent run up in last couple of weeks. A couple of days back, index gave a breakout about 25,200 marks, and after that, it really dwelled by more than 400, 500 points. And now it has come to the same zone. Even on the Friday, it formed a hammer sort of candle, which indicates the declines are being bought. So I believe that 25,200 could act as a major support. And with this support, we will continue to be with buy on decline stance. And if market negates the lower top, lower bottom, then again, it can rebound to 25,650 to 25,800 level. So with the support of 25,200, I would suggest to go with buy on decline stance in the market, as India VIX is holding near 12.5 levels. And put call ratio is clearly getting stability apart from other data internal. Looking at the bank nifty index, that is slightly underperforming, but holding the key support zone. It took hurdle at the upper band of the trading band, but at the same time, 56,500 could provide as a key support for a recovery towards 57,500 to 57,750 in the banking index.
Okay, all right, got that. Hi, Chandan. Good to see you as well on the show. Mitesh, you go first, though, with regard to stocks. What's on your radar?
Yeah. I have a mix of buy and sell calls. On the buying side is BPCL with a stop at 340 for targets of 360. GMR Airport is a buy with a stop at 88 for targets of 94, and IIFL is a buy. Keep a stop at 468, look for targets of 485 here. And one sell call, that's Angel One, sell with a stop at 2805 for a short-term target of 2700.
Okay. Chandan, what about your trades?
Yeah, so for my side, first is buy on IOC, Indian, or positive on the oil marketing company. So Indian Oil is the first trade with support of 147, expecting the target towards 159. It has given a range breakout on the daily chart and witnessed higher than average trading volume with sustained buying interest. In fact, we have seen support of 50-day exponential moving average and longs are being added. So expecting 5 to 7% run up in the counter, apart from some buying in HPCL as well. Second trading idea, that is buy on Muthoot Finance. It has seen a consolidation breakout of last 14 trading session. Longs are being accumulated with sustained put writing. So one can buy with support of 2600 for an upside target towards 2800. Last trading idea, that is buy on HL, Hindustan Aeronautics Limited. We have seen positive price setup in most of the defense companies, and HL is one of the strongest counter, which has given a consolidation breakout on the daily and the weekly chart. In fact, it has given a decisive hold above 5,000, which could see the next leg of rally towards 5,200 to 5,350. So one can buy with support of 48.85 for an immediate target of 5,200 marks.
Okay, all right. Thanks a lot for that, gentlemen. For the time being, though, we'll slip into a short break. You come back, we'll get you the pre-open rates. We'll also be discussing all things defense. Harshit Kapadia of Elara Capital will be joining in.
Okay, welcome back. There's about 14 minutes to go for the market open, and we are just, getting into it. Prakash Diwan is still with us. Prakash, we had Mitesh with a sell call on Angel One earlier, a technical trade, but I mean, that kind of sort of gets me to the capital market pack of names. Novama was down sharply, BSE was down sharply, Angel lost about 5-6% on Friday. What's your view? The Jane Street impact? But it's not just Jane, right? I mean, other similar players perhaps could also not be under scrutiny. We don't know for sure for now, but they could pull back in terms of activity. What is your sense?
No, I as I mentioned on Friday when the news broke out, there will be an impact on this because the activity levels will drastically get subdued. And there will be a shift into other asset classes or other sub-asset classes, if you will. Which means that some of the brokerages will get directly impacted. But, the entire complex of capital market plays has much more to offer than just brokerages. And those are the ones that are getting exchanges. Brokerages might get impacted because of volume shrinkage. But if you look at the mutual fund side, it continues to be very steady. It gets much more efficient. You have funds now launching international funds as well out of the GIFT City. So, that's the space you could probably latch on to. So whether it's a CAMS or K-Fintech, it's your choice in terms of what you like. They have different portfolios and there is differentiation. So depending on what an investor likes, you could choose out of that. But my sense is AMCs and all of these activities will continue to offer very good opportunities, which are long-term, secular, and fairly undisturbed. So it's just one pocket of the market that's likely to get impacted, but the other opportunities continue to be strong.
Okay. All right, Prakash, we'll leave it on that note. Thank you very much for joining in. Good to get all those thoughts in today. It's just about 9 a.m., so we'll start reflecting the pre-open rates. In fact, let's pull up the implied open. Nifty is down 110 points right now, which is a little worse off than what the implied open was telling us. That was showing a 50-point downtick. Let's see. It'll settle. In the meantime, let's put the spotlight on the defense sector. Now, we remember the news on Friday. The Defence Ministry has cleared 10 different proposals worth over 1 lakh crore rupees, 1,05,000 crore rupees to be precise, to buy weapons, military equipments, a lot of the surface-to-air missile systems, a lot of different procurement. Now, what does this mean for, again, stocks? And stocks are also getting quite excited with this news on Friday. We have Harshit Kapadia, Vice President, Defence at Elara Capital, joining in with some perspective. Harshit, thanks for joining in. If you had a chance to look at the nature of these defence acquisition proposals, who are the likely beneficiaries? I mean, it's the usual names, I guess, Bharat Dynamics, etc. But tell us more.
Yeah, morning. So in this 10 proposals, there are 3 major proposals which has caught an eye of this 1 lakh crore. First is the SAM missile, which is surface to air missile. Though it is not explicitly mentioned what category of the SAM missile is, we understand this is quick reaction SAM missile, QRSAM. The size of the order is estimated to be 30,000 crores, and the key beneficiary of this particular project is Bharat Electronics, Bharat Dynamics, and Astra Microwave. Apart from that, there is a mine countermeasure vessel, that is MCMV. That is another project of upwards of 40,000 crores, and we have shipbuilding companies who could be beneficiary. Goa Shipyard could be leading this entire pack of 12 such MCMV. Apart from that, two smaller projects, which is armored recovery vehicle, that is close to around 4,000 crores, and here the biggest beneficiary would be BML, followed by AVVNL, and could be Bharat Forge. Apart from that, there is other weapon system called as Mood Mines, where we think the beneficiary would be two companies, Bharat Dynamics and Apollo Microsystem. Here the size again would be around 4 to 4,500 crores. So these are some biggest projects which have been announced out of this 1 lakh crore. Apart from that, there are smaller size projects coming from electronic warfare systems, etc., where Bharat Electronics could be the other beneficiary along with Data Pattern, Astro Microwave.
Harshit, good morning. Is this all new? When I say new, I mean, was some of this penciled in by the street that this was coming and has been announced, or this is all kind of new in that sense and it'll lead to earnings upgrades?
So this Defense Acquisition Council, meets once in a month, and this is where we get to find out all the proposal which can come in or can become an order inflow in future. It generally takes around 12 to 18 months. Out of the list of 10, QRSAM was anticipated, but others were not anticipated. We just heard that these would be coming in future, but most of this were most of surprise for us, as far as the list is concerned. But QRSAM was anticipated within the 10 list.
So which companies will actually see estimates change? Yeah, because of this?
So two companies may see an estimate change. Bharat Dynamics, that would see a much more positive order inflow momentum from here on. Apart from that, Bharat Electronics may see some upside because of their role in most of the system, whether directly or indirectly. So these are the two names which will be the biggest ones.
All right. Hi, Harshit. Good to see you again. Harshit, what's your top buy call from the sector?
So my top buy call is Hindustan Aeronautics from the defense sector, and on the private side, it is Zen Technologies as far as defense is concerned. But apart from that, we also like Bharat Electronics on the PSU side. As in on the defense side, though we don't cover it, but we still like Data Pattern and Solar Industries on private side.
Right. The private side, Zen Technologies has been a stock that's done very, very well. However, the cash from operations are still negative. They've been promising that will turn around this time around. What are you penciling in terms of earnings, cash flows as well for this year?
So I have penciled in around growth of around 10% as far as revenue is concerned, given that the ministry was not able to give out orders which was anticipated in Q4, and even in Q1 we are not expecting a lot of orders to come. Probably in Q2 is where the order inflow will come, and hence the execution may be a bit slower in the second half because of not high order inflow base. So that could be a bit of a challenge for Zen. But the two technologies which they are largely involved in, the simulation and anti-drone system, is in high demand, not just domestically but also globally. And we will see the order inflow rising probably the second half of this financial year, and that may see a further upside for Zen.
Harshit, did you see this news report? It says that the government is going to launch about almost a $250 million incentive program for drone makers. Did you see this one, and any thoughts on this?
So yes, so government is looking to incentivize drone, because drone equipment had some of the other way component coming from China. And given that we are in the midst of two great wars which have happened, and what we have learned from the war has been what new systems or new age system is the requirement, and hence the government is looking to further incentivize apart from the earlier PLI which was given for the drones manufacturing.
The problem with drones, though, Harshit, has been that there is no way to estimate like a TAM, right, for the sector? I mean, can you estimate the size of orders every year? It's not possible. I mean, it's kind of ad hoc, right?
Yes.
But this does show focus for that the government is, and of course, I mean, the other one was, I don't know if you saw this again, that the unmanned aerial vehicles, some $470 million on UAVs. I'm not sure this is. I think this was another program for local industry, etc. So we're talking about some pretty large numbers here.
Yes. So see, the kind of the wars which have been fought, and what the equipments which have been used, the government is trying to revamp its overall modern equipment portfolio, both on the unmanned aerial side as well as on the underwater weapon system as well, which could be autonomous. So on both front, government is looking to add more numbers. The recent conflict also, showed us that this is the future of the war. There is no one single, product category within the drones where one can say and try to estimate a size. So TAM would be something which is very difficult because it's only a rising market. So nobody, is not sure on the TAM side, but it's going to be a big market for sure. And given that there are many manufacturers of drones in India, so it would also be difficult to pinpoint only one company who's getting majority of the order. So there will be a new company who will always be getting one or the other order. That's why drone is become more of a commodity market.
Yeah, okay, that's interesting. And you said that Zentech and Solar are your top picks in the private sector side, and on the PSU side, it's BEL. If you just recap the name.
So on PSU side, it is Hindustan Aeronautics and Bharat Electronics are top picks. On PSU side, it is Zen Technologies followed by Solar Industries.
Got it. Those are the 4 top names as the defense juggernaut continues. Thank you very much for that. Good conversation as always, Harshit. Good to get that perspective. Okay, let's get back to the market now that the pre-open has settled. And starting with a 100-point drop, now the Nifty in the pre-open is down just about 10 points. So let's see how this plays out. We have our trading experts back with us for some ideas. Mitesh, your 9-10 call?
Yeah. I'll go with the BPCL as a buy recommendation for targets of 360.
Okay, got that. In fact, I'm just checking if there's anything else noteworthy, what's sort of really pointing out in the pre-open. Not really. Trent, Nestle, some consumer stocks are doing pretty well. Actually, speaking of consumer, let's just revisit some of the key updates as well that came out. Dabur, Godrej, Jubilant, etc. Mangalam, run us through the most important ones again.
About Dabur as well as Jubilant Foodworks, because those were the most important ones in terms of what the street was expecting versus what these companies have delivered. Dabur, they've said that, they saw sequential recovery in demand along with an uptick in volume growth, but the consolidated revenue was impacted by the beverage portfolio, which saw a big gash on account of unseasonal rains and a short summer. Remember, beverages account for around 10 to 12% of their overall revenue. So if that has fallen a bit, that has led to the consolidated revenue expected to grow in low single digits as against mid to high single digits, what other companies have reported. So to that extent, we'll expect Dabur to see a red opening. But thereafter, could there be recovery? Because the company believes that their other verticals, home and personal care as well as the healthcare business have done well, and they are likely to improve going forward as well. So will there be a dip, and will that dip be bought into is something I'll watch out for. The other one is Jubilant Foodworks, 11.6% like-for-like growth, 18% growth in the India business, and them having added 60 Dominos stores in the country bodes well for them. This is the third straight quarter of good growth coming in for Jubilant Foodworks. The stock has seen a rally already, very close to all-time highs, previous all-time highs. Will there be enough valuation headroom for the stock to move further higher on the back of these numbers is another thing that I'll be tracking today.
Okay, all right. Thanks a lot for that, Mangalam. Let's hop across to Vivek. He had that big exclusive break on Friday. Let's revisit that story. Vivek, take it away.
Well, a quick follow-up, to the story we did towards the closing as far as Friday was concerned. Remember, on Friday, we had reported that the listed Bosch entity in India was looking to fold into itself 2 key unlisted entities. The 2 unlisted entities were Bosch Chassis Systems, which holds the key ABS systems or the anti-brake, anti-skid braking systems business in itself, and the other one was Bosch Auto Electronics. Now remember, Bosch Chassis Systems actually has the highest market share as far as the key ABS system was concerned. We had written to Bosch, while they did not respond to us on Friday post-market hours, Bosch uploaded a response to the exchanges where they have said that they do continue to evaluate various strategic opportunities in the ordinary course for growth as well as expansion of its business. They said that there is no material event or information that requires disclosure at this particular stage, but we'll continue to track for any developments on this particular front.
Okay, all right. Vivek, thank you very much for that. So that is Bosch for you. Just about, a minute to go for the market open, which should come up in just a bit from now. So we'll just track some of these stocks in the pre-open and where they've left off. Maybe just look at the capital market plays as well, if you can. If you have time to pull them up, BSC, Novama, Angel One, etc. And I think we should be going into market opening quickly. Angel is down about a quarter. And Novama is absolutely flat. You've got, I think, BSC, which should be unchanged as well. So nothing very much big impacts, though, on Friday. What do we have? First rates coming through. Before we go any further, we'll have this. We'll have the index rates coming up. Nifty 25,460, absolutely flat. The Nifty Bank is down about 0.13%, 56,960. Sensex 83,300 and 83,350, 340. The small cap index is absolutely flat as well. You know, you've got very, very subdued kind of rates coming through. So a quiet start. Will it be quieter markets is the question as we go forward. We'll see. But for now, it's not very much at all coming through. The Nifty heat map will give you a quick sense of what's up and down in the Nifty. I mean, the majority is down in the red, and you got a few winners up in the green as well. HUL trend reliance. For the Nifty, it's about 20-point cut right to the word go. Surabhi.
Actually, some of these Q1 update results are very, very interesting. Godrej is getting the full marks. It's the best performer in terms of all the weekend Q1 updates that came in. Almost 5.5% higher. Keystone's numbers are very good as well. Keystone's up 4%. But look at Jubilant. Jubilant, the numbers looked okay. Q1 update, 11%. Domino's growth, but stock's down about 2%. Anyway, more on the updates in just a bit. Let's talk about what's moving the large cap screen. We're 40 points down on the Nifty. BEL, Tech Mahindra, Indent Bank lower by about 1%. Indent Bank also lots of issues on the business side. I mean, the stock's fairly resilient actually. I mean, if you judge by the metric of just what they've done in the first quarter. But anyway, that's Indent. HCL Tech, Shriram Finance, Bajaj Finance, financials are again weak. I mean, banks and non-banks. ICICI Bank, lots of weakness over here. Early weakness that we can spot. Tech Mahindra, Wipro, Infosys, so even IT is not really firing up for the bulls today, at least not at this point in time, early in the morning. So let's see what's holding up the green side. It's actually all consumer. That great consumer trade has begun, and this is what we discussed a lot, even in the editors' roundtable yesterday. Nimesh had put out a piece. Now, the question is whether this trade will really reach its logical conclusion. HUL, Asian Paints, Trent, Nestle, Tata Consumer. I'm reading on the top 5 names on the Nifty, and they are all consumer. So that's where the market focuses. That's where the expectations are running high, and we'll have to see if the companies can deliver.
Well, that's right. You know, and let's focus on a few names then. The OPEC Plus cut was actually OPEC Plus hike of crude production was 30% higher than what was expected at around 570,000 tons barrels per day. In fact, the expectation was around 410,000. So you have HPCL actually that's open gap up. So keep an eye out on that one. Besides that, Goodish Consumer, Novama said that they were quite positive on the revival, and the evidence was in the numbers as well. They're expecting things to bottom out. That stock's clearly flying away. Dabur, with the numbers didn't look so good. Well, that stock as well is higher. Dream folks, we did see some fund-based selling. And that stock, in fact, has now gone to around 180 rupees, falling on massive volume, 6.5% lower. In the last 45 days or so, the stock has lost close to around 30% of its market cap. So big downtick is what we're seeing on that one. Kalyan Jewelers, well, the numbers look pretty okay, but the stock has come in for some profit taking. So that's down close to around 2%. DCX Systems from the defense names, well, that's moving higher in relatively large volumes. Close to around 3% higher. Volumes much higher than what we normally see. So big up move is what we're seeing on that particular name. The other one that's moving well, Sirca Paints. We don't normally talk about this name, but that stock, in fact, is higher. And Axis Gates as well is up close to around 5%. And that's been moving on a periodic basis on circuits. Keystone Realtors, Rustam Ji, the reason that the stock is higher is because the pre-sales have grown by 75%. Remember, they've already clocked 1,000 crores. Last entire year was around 3,000 crores. So the street likes that. Also, business development in the first quarter, they've added 3 new projects. GDV of around 7,700 crores. That's surpassing the entire guidance for the year as well. So on the back of that, that's holding with a gain of around 3.5%. Thumbs up on that name.
Okay.
By the way, Nigel, did you mention Borisul Renewables?
No.
Very interesting, and that's what we were pointing out. There is the German subsidiary that's filed for bankruptcy, but why is the stock still up? Because it's a sense of relief and maybe a sense of completion, and let's move on beyond this, because it was a loss-making entity. I think Borisul's exposure was over 300 crores to this, and maybe the market is seeing as some finality and then moving on to the repair work. Prashant.
Absolutely, and more on Borisul, and we'll of course try and get in touch with the management as well as we go along. What do we have on the downside? It's interesting. BEL is the top volume-led loser. It's down 2%. And Paras Defense is down about 5% as well. Now, it's not, defense in every country is very different. But last week, the best performing defense pack in the world has been Korean defense companies. They were all down. There was that entire pack, the index was itself down some 8%, Friday to last Friday. So, we'll see. Here, of course, news flow has been positive, but stocks, of course, have run up in some cases far ahead of the news flow. In any case, there's this order-related tailwind here. We'll see. Angel is down 2%. There was a call from Mitesh which came in earlier. Kalyan Jewelers is down 1.5%. Jubilant Food is down about 1.7%. Indus Tower is down about 2.5%. Garden Reach is down about 1.5%. Dream Folks, Nigel mentioned 180, down about 5.5%. Credit Access is down about 1.33% or so. Deepak Fertilizer is down about 2%. But then after that, volumes really fall off a cliff. So just there's serious volumes, at least out of the gates, in about 10, 12 names. That's it on the downside. But more on the upside, but not really that much. IIFL is coming up. It's almost nearing that 500 rupee mark after a while. So IIFL has seen a fair bit of repair and recovery over the last few months now, actually, last 4 or 5 months now. Relaxo is coming up. That's the chappal maker, 6% higher, 492 on Relaxo. It's the fourth largest volume-led gainer on the NSE. So it's price gains plus volumes. Shipping Corporation of India is up 3.3%, and Goodish Consumer is up 5%. That's the largest volume-led gainer, which is coming up right now. So more on this as we go along. But for now, it's Nifty back in the green, but just about 10 points or so. Still pretty quiet, 24,472. Manish Sontalia is with us now, Chief Investment Officer at MK Investment Managers. Manish, good to have you with us here. Thank you very much for your time. Let's just sort of dive straight into the capital market plays, which has been such a darling for the street for obvious reasons. Do you think that trajectory, especially not for all, but for some, not obviously for the wealth guys, etc., but for some gets dented because of the regulatory actions we've seen? It of course started with on the F&O side, but now we're seeing it on the Jain side, etc., as well, and I think needed. But there are secondary implications as well. What's your sense?
So Prashant, I think it's just a blip. Capital market plays a strong place going into the medium and long term. Of course, there's a knee-jerk reaction on the downside. Exchange volumes are going to fall 4-5%, to say the least. But I think newer players are also going to enter the F&O space now that this one entity would be out, and there'll be normalcy in terms of the trade patterns, etc., on the exchanges. And given the fact that March onwards, you have seen a very strong capital market rebound, which is going to have a rub-off impact on your earnings for the first quarter as well. All capital market entities are going to report better than estimated numbers. That was the case in the fourth quarter when the markets were really down. So all in all, I think the capital market plays are a very good buy on dip. And obviously the RTAs, the online brokers, the depositories, they would all be fantastic plays, the wealth management guys. Yeah.
Okay. Manish, hi. Thank you so much for joining in. I want to straight away get to you on this whole consumer debate, right? Because we were just saying this, and this has been building for a while. the market's big hope on the return of the great FMCG juggernaut. I mean, if not FMCG in some format, I'm saying, bottom or middle of the pyramid consumption, because till now consumption is only top of the pyramid. Expensive watches, jewelry, top dollar apartments, etc. Do you actually see the bottom of the pyramid consumption coming back? And if you do, then what sort of stocks would you be looking at?
So, I've been maintaining for a while that consumption is going to make a comeback. The pendulum is going to shift away from investment-related themes to consumption-related themes, thanks to the government's impetus on providing income in the hands of the middle class. That was not the case over the last 2 years, where they have been beaten down heavily by inflation as well as very high taxes. Come this financial year, obviously, you have 1 lakh crore savings in income tax, which will create a multiplier on the consumption side, more on the discretionary consumption side, and also on the rural consumption side, that we are seeing that, rural economy has turned a corner and monsoons are pretty decent. So even that is going to have a positive rub-off impact. And obviously, the consumer names, you can deal with anything. Of course, one needs to figure out where the consumer would primarily have preference first. So it could be your, travel, it could be your hotels, QSRs, you could be dealing with automobiles, personal vehicles, health insurance. These are some of the consumer discretionary gains which are definitely going to benefit. Of course, you have another added impetus coming from 1st April 26, which is the 8-day commission. So all in all, the consumption names have not done well over the last 2 years. Now it's the time to actually, for them to actually have an outperformance going forward.
Hi, Manish. Good morning. Good to see you, Ben. You don't shy away from stocks as well at times, and on a periodic basis, every conversation you've given us one. Star Health, I recall, it was the one that people were not looking at. You said, post the correction, valuations and the business itself seems to be looking up. And that's been actually a contra call that's worked very, very well, if someone heard you. But the question is, today, what are you going to be telling us? Which is that stock that you're actually looking at, which could have underperformed, has valuations in favor, and prospects look up from here on? Please go ahead, Manish.
So, Nigel, ever since RBI has given a front-loaded rate cut and pretty heavy dose of liquidity, I think some of the, the capital market players, and we alluded to the names, the all well-known names, these would do well. You will have the real estate. So the whole thesis is that markets are going to overshoot fundamentals. And obviously, we are closer to now all-time highs, and they'll be overdoing things. So asset price inflation is basically the major theme going forward. Plus combine that with consumption, which is basically having a fundamental thing. So all the real estate names, the NBFCs, you have many of the NBFCs, the housing finance companies, not the PSU ones, but the private sector ones, which are projecting 20% sort of a growth available at, let's say, 1.5 times PEG, so on and so forth. Or you'll have, let's say, the public sector banks per se, which are available at very decent valuations. You'll have the infrastructure names, which gets boosted due to lower cost of capital as well as benign commodity costs. So these are some of the areas where I think, the new underlying bullishness would come through just because of the RBI's action very recently.
In each of these themes, you want to give us one particular name?
That's difficult, Nigel. You know the regulatory constraints.
Manish, just to go back to that point on consumer, since you're convinced that there is indeed going to be a pickup again, but what would be the best ways of playing it? Would it be plain vanilla FMCG? Should it be, two-wheeler companies? What else are you looking at? Could it be QSRs, for instance?
Hotels, consumer tech, look at QSRs, you look at fast fashion, retailing, whether food retailing, whether apparel retailing. These are some of the names where you have fantastic names available. Jewelry retailing, to say the least. Ethnic wear retailing. These are some of the names which will benefit. And as far as FMCG side is concerned, let me give you some insights. One insight, basically, which I have gathered over the recent interaction, is that, D2C is hitting the incumbent FMCG companies in the urban markets. And, there is heightened competition in the urban, because FMCG broadly are areas where things are very, very penetrated. You have the soaps, the toothpaste, etc. So how do you beat the D2C, which is really competing in the urban space? So FMCG, those players which are actually focused on the rural space would tend to benefit more because there you have lesser competition from D2C per se. And, if the rural economy is turning, then FMCG players focused more on rural areas are likely to benefit.
Yeah, no, okay. FMCG plays focused on rural areas where there is lesser competition from some other D2C players is what you're focused on. Actually, my question was consumer. Anything else consumer apart from FMCG? If there is this consumer pickup, which has been long awaited, but which is not really materialized, anything else? Any other segments you're focused on?
Hotels. Hotels are going to benefit magnificently. Anything to do with travel, and hotels basically are the business of managing sleep. A guy has to sleep at night, and look at the number of passengers traveling every day. 5 to 6 lakh passengers traveling by air. You have 1 crore passengers traveling by train, and you have 1 million passengers traveling by road. Now, assuming half of them actually stay with the relatives, the balance half have to sleep at night. And this would include all the unorganized guys, the OYOs of the world, the Airbnbs of the world. Plus, you have just the number of organized hotel rooms in the country, anywhere between 3.5 lakh rooms. And supply of hotel rooms can't exceed more than 5 to 7% every year. Just you see the demand and supply gap that is existing as the economy grows between 6.5%. We are not only talking about leisure travel, we are talking business travel. And look at the occupancy rates, 70% plus. Tariffs are on the up move. And, you have the ARRs, which are...
Yeah.
No, and you just got to...
No, but Manish, the story, I mean, no one can debate the story and the potential because I think it's a reversible change. When we talk about where we want to spend the money, I think taking a holiday or a short trip is the first thing that comes to people's mind. The question is on valuations. Where do you see valuations? Are they comfortable, not? Indigo's, for instance, at all-time highs.
No, so Ravi, you got to actually figure out the certainty of the earnings coming through. And in the case of hotels, of course, you could debate that last 2 years rate of growth might not come through in the current year. But can you see the next 5 years of growth come through for the hotel space? It is a given that given the demand and the supply mismatch, I don't really think valuations are going to come off very, very easily. So you'll have to basically have a waiting game as far as you're making money from the current price levels. But there is higher degree of certainty that valuations won't correct massively. So you'll have, let's say, the leader in the pack. Then you have to figure out the discount vis-a-vis the leader. But it all boils down to growth, the margins, and I think margin certainty looks pretty okay in the current scheme of things. So yeah, the valuations are not very cheap. So is the case with, let's say, hospitals. The demand and supply gap is just too big. Are you seeing any comfort in terms of near-term valuations for hospitals? No. But are you seeing growth come through for the next 3-4 years? The answer is a yes. We'll have to wait.
Hotels and hospitals, Manish?
Yeah,
or both, or hospitals like hotels?
Yeah,
joke.
Cutting out your real estate.
No, real estate. And you got to sleep, as you said. Interesting conversation. Thank you very much, and we'll sort of pick up on some of these points as we go along in the future as well. I think we have the next management. IKS Health Services is with us. They've done an acquisition, and now the company is with us to talk about that acquisition. So let's bring in Sachin Gupta, founder and CEO at IKS. Sachin, good to have you with us here. Good morning. Just take us through this acquisition. Is this a different segment than what you do? Because what I read is this: they kind of sort of upstreams the alignment with physician group via what is called the MSO, which is what you've acquired, Management Service Organization. So very simply, what you do and what this company that you've acquired does, and what are the benefits? Go on.
Good morning, Prashant and team. Thank you for having me. So essentially, this is a joint venture where we have acquired a 48% stake in this management services organization that essentially is going to provide all the administrative services necessary to run this about 100-odd doctor-physician group that is in the Pacific Northwest, just outside of Seattle. And it really is a part of our larger strategy to go upstream. And if you don't mind, I'll take a minute to explain why we even came up with that strategy. But if you really think about it, the US healthcare market has consolidated rapidly. The physicians, there's about 950,000 physicians in the country. And it was a highly fragmented market when we started the business 60% odd of the 950,000 physicians existed in groups of 5 or less. Fast forward 18 years, more than 60% are now in consolidated entities, either owned by private equity or owned by large hospital systems. Unfortunately, the key drivers of those consolidation, which is to lower total cost of care, improve quality of care, improve access to care, and improve the patient experience. When you look at those metrics, the consolidation hasn't been able to truly service those key metrics that would improve healthcare. In parallel, IKS built our platform, where at the deployment of our platform, these physician groups, one, are able to reduce provider burnout, improve physician-patient engagement, and hence quality of care, and fundamentally transform their own economics by deploying our platform, which produces nearly 1,000 bips of incremental margin over what they are able to produce after paying for the platform. So, by the courage of conviction that we got from the transformational impact of our platform and the macro in the industry where consolidation hasn't really worked, this is our first attempt to go upstream and say, not only will we deploy our platform in the physician group, but we will now create a second pool of economics for ourselves where we will participate in the upsides that are going to be created through this joint venture entity. And in this entity, what will happen is we will own about 48% equity, and the overall revenue of the medical group will be split in a way where nearly 63% of the revenue accrues to this MSO, in which we own 48% stake, and the balance 37% will be going directly to the physicians to pay for their compensation. And then as we deploy the platform through the MSO to the medical group, we will then start seeing the benefits of the platform accrue in the MSO. And hence, now the one pool of the economics is the economics created in the MSO entity, and the second pool of economics is the traditional economics that we will create in the IKS P&L through the deployment of the platform via the MSO.
All right. Hi, Mr. Gupta. Thanks a lot for joining in. Just a simple question. IKS has been focusing on improving margins. I think they scaled past the 30% odd mark. With this MSO that you're talking about, how does it change the margin trajectory from here on? And will it contribute to the upside?
So, Nigel, what we've essentially always said is that we are on this journey post our acquisition that we did in October 2023, prior to which our margins used to be north of 37, 38% EBITDA, which came down to blended margins of about 24. We said we were back on this journey to bring the margins towards the early to mid 30s. If you see our Q4 results for the last fiscal year, we'd already hit a north of a 31% EBITDA margin. So we were ahead of that plan. We think there's still a little bit of runway left in that plan, which I've said publicly in the past. And so there's nothing new that I'm saying here, and we're in the quiet period. But I think we're in that journey of sort of settling somewhere between the early to mid 30s in EBITDA margins. And this deal doesn't fundamentally impact that trajectory. This deal, obviously, there'll be another set of economics created in the MSO, in which we own 48% interest, but the traditional margins for IKS will still continue to be in the range, and that the trajectory that we are going still on, which is to get to the sort of early to mid 30s in the next, say, 12 odd months, we're still very confident of achieving that.
Manish, and what about revenue growth post this acquisition?
Revenue growth, I've always said, Prashant, that the market's growing at 12%, and we look at ourselves as a 15, 20-year growth story from here in a very large TAM, and we believe that we'll continue to grow faster than the market on constant currency terms. Whether now in some, this business isn't as predictable where every quarter is going to be linear, but my whole idea is we will definitely grow north of 12% constant currency, even better on actual currency. And, some quarters will be significantly higher, some quarters will be in that range, but we're confident of that sort of long-term earnings growth trajectory of north of 12% and non-linear growth in margins relative to the growth in revenue.
All right. Mr. Gupta, quick question. I'm just looking at your cash flow. Free cash flows, they've been moving up. Your net debt number as well has been gradually coming down. So you're going to be having a bigger cash pool to spend on. What's it going to be on? What kind of initiatives are you going to take? Is it going to be on technology as well? If you could give us some kind of insights.
Yeah, I think the two drivers of investment, Nigel, will continue to be, of course, we are continuously increasing our technology spend, even though we don't, for the most part, capitalize our R&D spend. If you see our R&D spend over the years, above the EBITDA line even, it's gone up from the 2-3% moving towards 5%. As we continue to make our big investments in AI, that spend will continue to go up even as our revenue increases towards the 5-6% mark. The other big investment really from a cash perspective will be strategic initiatives like this, right? We've invested $17 million in this deal to acquire the 48% stake. We will have the ability to invest more if we want to in this deal. And our idea is if deal constructs like this truly start to work out, we're going to try 2 or 3 of these. then it fundamentally changes both the positioning of the business and the upstream opportunity that we create for additional growth. And so I think it's strategic alignments with customers like these, and then continued increased spend on the P&L in technology, as well as we'll continue to do some potential tuck-in type early tech acquisitions. Those would be our primary uses of capital.
Okay, all right, Manish. Thank you very much. Shorter conversation, but we're on a earnings treadmill, news flow treadmill today. Thank you very much for joining us, and good luck with that acquisition. More later. Let's shift focus back to the defense space, right? Defense stocks all in focus. Lots of tailwind. HAL is perhaps the most loved of the defense names, really. They've given a 8 to 10% revenue growth guidance for FY26, is aiming for 14 to 15,000 crores in capex over the next 5 years. My colleague Mangalam caught up with DK Sunil, chairman and MD at HAL, to talk about their growth outlook, and began by asking him where the company stands in terms of order inflows. Listen in.
Basically, from the 97 LCA order, which is going to be big, upwards of 60,000 crores. So that's the big one which we are now working on, and we expect to close it this year. On an average, we do about 20,000 crore of RMSO orders, which are the regular repair maintenance orders. This year, we will be shortly closing a 2,000 crore order for the Dorniers, which is in the final stages. But the year, we hope we will be able to bring in that kind of number, about 1 lakh crores.
Right. Very recently, the Defense Acquisition Council also went ahead and announced procurement plans worth nearly 1 lakh crores. Does HAL stand to benefit from that?
Yes, in fact, one of the items was the Sukhoi 30 upgrade, which is a upgrade of the avionics for about 84 aircraft. So this was earlier cleared in the DAC, but there was some clarification which got cleared in this DAC. So now the CCS paper will move. This will be a very big R&D effort for the Sukhoi 30, which will take about 5 years to complete. And 84 aircraft will be upgraded, and that will, production will, the overall and repair and the upgrade will pan out after 5 years. And it's expected to be about 65,000 crores.
All right. And you've also bagged a 156 unit order for LCH. When does execution begin on that one? And what is the annual run rate that we can expect from the Tumkuru and the Bengaluru plants for this one?
The contract was signed in March this year, March of 25. So 3 years is the start of production. So FY28, the aircraft will start rolling out. And we expect to produce at the rate of 30 aircraft a year. So the whole run will be completed in about 6 years. The split will be mostly, it will happen in Tumkuru now. Initially, a few will be built in Bangalore facility, but we will move over to Tumkuru, and the helicopters will be built predominantly in Tumkuru. We already have started producing the LUH there. So the facilities are up, and that will be expanded to cater for the LCH also, which is the Prachand.
All right.
We expect to close it in 6 years from FY28 onwards.
6 years from FY28. You did say that there is maintenance, repair, overhaul of almost 20,000 crore rupees coming every year. Not only that, you're also looking at some sort of MRO for civil aviation. So just wanted to understand your own vision on how much do you expect MRO to be as an annual business for you going forward?
I think we are still taking baby steps in the civil MRO. We have tied up with Airbus, and we are getting our facility and people certified at the Nashik plant. And end of this year, we will have this certification of both DGCA as well as the EASA certification, the European certification. So our expectation is the initial numbers will be small, nothing much to speak about, maybe 100, 200 crores. But going forward, we want to make it as one of the important verticals. So this will build over a period of time, but the initial numbers are going to be small. So the investment that we are making is essentially for the long term.
All right, so all said and done, what is the kind of revenue run rate that you will do in FY26, FY27 and FY28? I ask you this because you are sitting on an order book of roughly 2 lakh crore with an order inflow of roughly 1 lakh crore in this year itself. If you could give us a glide path of the revenue that the company will be posting over the next 3 to 5 years.
Yes, we are looking at the growth, double-digit growth. We had a setback last year because of the supplies of the engine. But definitely our growth will, going forward, be much higher. Definitely 8 to 10% or more. And we expect that as the different aircrafts go into production, the LCH will get into production in FY28. We will now be doing the procurement, and the LCA, of course, 83 is already on. The 97, if the order is concluded this year, it will get into production 3 years down the line. So we see a very healthy growth in the top line. 10% is definitely doable, and much higher than that is what I expect.
You've earmarked capex of what, 14 to 15,000 crore over the next few years. Can you break that up for us? How much of that would be deployed towards aircraft? How much of that would be deployed towards MRO? How much of that would be deployed towards something like a helicopters? If you could break that capex up for us.
A lot of it is in the R&D. We are spending almost 4,000 crores for the IMRH program. We are spending the capex in the Tumkuru plant is going to be of the order of 2,000 crores plus. And we are also investing a lot of money in other projects of R&D. So predominantly over the next few years, the investment in the facilities, investments in software, investment in test facilities, this would be of the order of, for the next 5 years, of about 8,000 crores. And the balance would be mostly in R&D projects going forward, which are all big ticket items like the IMRH or the CATS Warrior, HLFT. These are all big ticket projects where the funding is from HAL.
Drones. You said that there is a test that you're working on. Do you see orders coming in for UCAVs? What's the opportunity size here for you?
Definitely. As has been demonstrated in the Ukraine war or the recent conflict between Israel and Iran and so on, we're seeing that drones will play a big part in these conflicts. However, we are focusing on the bigger UCAVs, which will be, the UCAV that we are working on is 3 ton, and we expect it will be higher in the future years. So this UCAV business is going to be big in the future. Right now we are working on the design and development of the UCAV, and we are at a stage where we are integrating the test engine and going forward. But my expectation is 10 years down the line, this will be a very significant chunk of our portfolio.
And also SSLV, because the street believes that space will also be a big part of your overall scheme of things in the next 5 to 10 years. If you could give us a potential market size here.
The SSLV, as you know, is a very heartening development that we have won it against competition. We expect conservatively to do about 6 launches a year. 2 years, the first 2 years we'll spend assimilating the technology and building a couple of prototypes. Subsequently, we look at conservatively 6 launches a year, which would easily add about 1,000 crores to the top line. and going up to maybe 15 launches a year based on how we are able to market it and get space. So I think in the next 5 years, we should have at least 1,000 crore turnover from this business.
You do believe that, revenues can compound at over 10%. You are looking at over 180 aircraft to be delivered over the next 5 to 6 years, which implies that at some point, all the 3 lakh crore of your order book that you will get over the next 1 year, including the orders that you have in hand, will be executed over the next 5 to 7 years. What kind of margins will you enjoy each of these years? Will you hold on to this 31-32% band, or do you have the wherewithal to go higher from here on as well?
No, I think we will maintain our current EBITDA. That is what I would like to say at this point. Definitely we'll be able to maintain this. And as you have pointed out, this 3 lakh crore will play out over slightly more than 7 years. It will be about 2033, about 8 years. But we expect to maintain the EBITDA, the current EBITDA that we have.
Have you heard from the government on them looking to further pare their stake, or you looking to raise some money via an offer for sale or something? Is there any opportunity?
No, right now I think we are at a comfortable level. There is no discussion on that. No discussion about dilution of the government stake.
Okay, well, that's the management of HAL, and we'll sort of play out excerpts of that interview. As I said, perhaps the most loved defense stock out there in the market, really top of the league. Well, I think 20 points lower on the Nifty, so it's turning out to be a pretty quiet start to the week. We'll take a quick commercial break here. Primary market action next in focus. We'll have Varun Kapoor and Vikas Kapoor of Travel Food Services Limited. It's a 2,000 crore IPO offer for sale. So that conversation coming up in just a bit.
Welcome back. As promised, let's talk about the primary markets now. Travel Food Services, 2,000 crore rupee IPO opens the subscription today. This is entirely an OFS. The promoters and the company have raised close to around 599 crore rupees by the anchor investors, and some of the notable names could come up for you on the screen as well. But let's talk about the business in detail as well as the IPO offering. Well, let's understand the business. We have Varun Kapoor, the MD, as well as we have Vikas Kapoor, the Chief Financial Officer, who joins us. Hi, gentlemen. Thanks a lot for joining in, and looking forward to interacting with you all more often. Well, let's talk about the financials a little bit first. I'm looking at it over the last few years. Revenue growth has been in the vicinity of the mid-20s on a CAGR basis. And EBITDA margins, could include the rent as well. So I'll stick to the PAT margins. PAT margins have been in the vicinity of around 22% or thereabouts. Right. Do you believe this sort of a momentum can continue?
So thank you, Nigel, for that. And thank you for having us in your studio today. So yes, our business, we focus on travel, QSR and lounges as a business. In aviation, we've built the business over 16 years, and we are today looking forward to accessing the public markets. In terms of our business, the business has grown quite well over the last few years. It has continued actually over the last decade or so, but last few years, you can see that trend very much being there, where we've grown strong in the business, and we expect that we're in an industry that's growing quite strongly as well, expected to have a CAGR of about 20% over the next decade or so. And with the, as you could say, the drivers of passenger growth being a key area of growth behind us, the tailwind that actually allows our business to grow consistently forward. In terms of margins as well, we have achieved margins of 21 to 22% levels over the last 2 years.
PAT margins.
PAT margins at our business. We do believe our teams are very focused on driving that. Our teams are very focused on initiatives. Our teams are very focused on driving those robust margins. And those efforts will continue. I mean, just to give a perspective, what drives that as well, our business is investing upfront. ROC is a big part of our business. We've achieved about 50% ROCs consistently over the last few years, including the last year, which we disclosed recently in our RHP as well.
Okay, all right. Just one more question before my colleagues come in as well. We talk about the unit economics as well. One big issue over the last few weeks has been what happened with regard to Dreamfolks. And it appears, they were the aggregator with regard to airport business. Right. Could you tell us, is there any kind of risk? Because their call was, the airport operators are putting pressure and various other claims were made. Is there any that sort of risk on your business, or do you think you'll protect it?
So our business, so we are the operators of the lounges.
Yes.
We work closely with our airport partners to create value for consumers, consumer delight. That's by designing, by building, and actually operating these lounges. Where we work with multiple partners, lounge access partners, whether they're airlines, they could be card networks, bank companies, or lounge access programs or loyalty programs like a DreamFolks would be. Ultimately, the consumers coming to the lounge would come to any of these partners for us. So we are agnostic, and in some sense, what's happening recently where they're actually tying up directly with us tends to be an advantage. Tends to be that customers are directly coming. We can communicate, we can actually create different levels of experience directly with partners as well. So, that's what's, in a sense, occurring today in the industry. So, in a sense, it probably occurs as a positive for the development of the industry.
I just want to also tell our viewers that yours is a very touch and feel business, so that to make it easier for people to understand, all the idli.com and the cafecinos that we see at a lot of the big airports, run by, of course, Travel Food Services, TFS. Vikas, just come in on this point on lounges, because that's a very big part of your business. Your current revenue mix is almost evenly split between your own brands and the food courts that you're running with your partners and this lounge business. Just if you could supplement this. If there is disruption and say the lounge business is taken away from DreamFolk, how does that impact your lounge revenue, if at all?
Thanks for the question. What exactly happens is the lounge business by default is, like Varun mentioned, is supplemented by multiple layers of like airlines, loyalty access programs and multiple. So what tends to happen is, if suppose there is a challenge on one lounge access program per se, typically you would either get the customers directly, or you would get a new access program provider who would be providing that services to you.
DreamFolks accounts for how much of your overall lounge revenue, which in the last year was around 830 odd crores. How much of that would be from this one lounge service provider?
So from that perspective, yes, there would be a sizable portion from that perspective, but the way it is happening is that most of the banks are directly tying up with us to provide the lounge access. So for us, there is no impact.
Those negotiations and that changeover period is already on.
Right.
Yes,
and we work as well, a big part of the business as well as airlines. Airlines has been the part, especially international when you fly, no doubt, that tends to be a big component.
Varun, Vikas, great speaking with you, and congratulations on the issue. So for a lot of viewers, a little confusion. Many are asking us online whether you are in the same line of business as DreamFolks, which you're saying you are not. They are an enabler, an aggregator, whereas you're the operator.
That's right. It's a very different business. They would be one of many lounge access programs we work with. We are the actual players who build the lounges. We actually operate these lounges. We take the real estate, and we have these long-term contracts. So our contracts are about 8 to 9 years. We work closely with airport partners. As they look at upgrading the whole experience at airports, we work very closely with them in that. So we're actually building these lounges.
Right.
Ensuring that the sambar is piping hot every time you
That's
what it is. And I'm very particular about my food.
That's great.
But don't get me started on the sambar, because I'll go on about the cost. And of course, online, you guys must see, right? People, there'll be the cup of chai which will come up and priced at whatever 800, 700 rupees, and
it's about different experiences.
It's a raging debate out there, right? But on the lounge business, the number of flyers has exploded over the last few years, right? So it's been a different league, in that sense. But access to lounges is also pretty democratized now. So many, it's not that hard in terms of the number of cards which are accepted, etc. How do you earn revenue in the lounge business? One is of course what you sell in the lounge. Right. Is there anything else at all?
And if I can supplement that question, because in between over the last couple of quarters, there was also a phase where banks were pulling back from this business because it was just not profitable, because every card could get you a lounge access. So your thoughts, going back to Prashant's question.
Right. No, exactly. And you see, ultimately it's about the consumer experience. You had restaurants and airports. Today I probably say, I think the way airport operators in India have approached airports, I think they made it in some cases better than malls on the high street in terms of the brand mix that you see. And we're focused on delivering that. We're focused on creating those experiences. So both, whether it's travel QSR with some of the brands you see at the airports, and lovely to know idli.com is one of your favorites. So that's a great testament. But in addition to that, lounges as well. Lounges are a place, you're traveling, you have high dwell times. You want a space of comfort. You want a space you can spend some time. It creates an environment or oasis of a cutaway from the rush of moving.
But you're contingent on banks being solid partners and bringing in the footfalls, right?
Completely. So whether it's a bank, whether it's an airline, whether it's a card network, and you're seeing more and more consumers appreciate that. And exactly to your point. And not only that, it's happening globally. I mean, India, no doubt. You're seeing that every time. Lounges, many times, are asked as one of the top reasons of, we're partnering with the card companies, banks, because the level of service every year is going up and up. Every lounge coming up.
If a consumer spends 100 rupees at a lounge that's operated by you, how does it split across you, the bank, and others?
So, Prashant, the way it works is we tie up with these access programs, and they pay us per user coming in. So we get paid per use. And I think what's happening as well today is, one is that is a part of the revenue. You have walk-ins as well. But in addition to that, you have people who come to a lounge, and today you see a spa. So, so additional services as well.
The value-added services.
Value-added services. So spa. Today you see, bar in a lounge.
So if you could give, numerically, if you can just sort of disaggregate that number, Varun.
So the larger portion would be the walk-in. I mean, the customers who come through the
card programs.
The card programs, the banks, the airlines. For example, international, you'd imagine airlines, business class. You're a first-class traveler. You come to the lounge. You have a separate zone for the first class, separate zone, for business class as well. So that tends to be a large portion of it.
And which business fetches you better margin? The lounge business, where all these tie-ups are vital for that business to thrive, or the regular food court business? Right. Which gives you better margin?
That's a great question. In reality, for us, it's materially both the margins. Ultimately, we're delivering from both of these consumer delight, and margins are quite similar across both businesses, not materially different. And a lot of synergies between both.
Right.
You have central kitchens, central stores, procurement is together. So a lot of these type of comments.
All right, just to wind things up, so you're confident with regard to the revenue growth momentum, profitability can be maintained, return ratios can be maintained, and you don't see any kind of risk like what's happened with regard to Dreamfolks, because your business itself is totally different. Is that fair?
That's fair, Nigel.
All right, we'll let you all go at this time, and all the best for your IPO opening. On listing, we re-invite you all on the channel.
Yeah, sure.
At that point of time, we'll squeeze you a little bit more for some numbers.
We love that. Maybe a few recipes we could discuss.
And I'm a customer both, lounges as well as the other business. So
super.
I can quiz you on everything on the operational front.
And one suggestion, maybe you could introduce a frequent flyer program for idlis and sambar.
Like a loyalty card. Absolutely.
Something like that is going on in the mind. So
nice.
Thanks, gentlemen. Thanks for coming down.
Thank you. Thank you so much. Well, that is TFS, a new issue that is coming to the street very, very soon. But let's go back to some important updates that we got from Borisul Renewables. Let's pull up the stock. Last I checked, it was still up about 3% or so. Now, the news is that one of Borisul Renewables subsidiaries, in particular, this is the German subsidiary, it has filed for bankruptcy, citing demand paucity and market conditions. The stock, however, has been holding up 4%. Perhaps the market feels a sense of relief that there's a finality to this, and now one can move on with the repair work. Let's discuss this with the company's management. Pradeep Kheruka, Chairman of Borisul Renewables, is joining in. Mr. Kheruka, thank you so much for taking this call, sir. So that's exactly what we need to understand. We believe that your exposure to the subsidiary was around 350 crores. But what is the debt remaining? What happens in the bankruptcy? And to what extent can your exposure be impacted? If you could just walk us through.
Sure. Thank you for having me. The debt in the company now is from Borisul Renewables itself. We have no external debt with banks or any other lenders. So to that extent, we are not facing any hostile action by any third party. The fact is that there has been a demand constraint, a significant demand constraint, because of a stoppage of manufacture of solar modules in Germany. All of these are now being imported from China. And the government has just taken office a short time ago, sometime around the 10th of May only. And I think they have so many issues to grapple with at this time that it's just going to take some time before they wrap their heads around the solar industry sector. But in the meantime, we have been losing money to the extent of nearly 900,000.
Oops, I think we've just lost that line with Mr. Kheruka. We'll try and get him back. But, that's essentially the thing that we need to understand. At least the bleeding stops, because this was a loss-making entity as well. So the market just seems to be relieved that for starters, at least that bleeding stops. And then it's a question of recovery of investment, whether that happens or not, in what form. That's something we'll try and understand.
So the only thing that I was surprised is that, as Mr. Keruka, before we got cut off, said that there's a new government in place. And they've got lots of things to deal with.
Yeah.
But they're sort of getting out of this business in Germany at a time when you've got a new entity which is expanding, the fisc, etc., in a very substantial way in terms of increasing spending, state spending on a lot of things. So why now? I mean, if anything, you'd probably wait for a bit longer, or were there other circumstances as well which kind of sort of forced them and forced their hand? I think Mr. Keruka is back. Mr. Keruka, you got cut off there, sir. Please continue.
Sorry about that, yes. Swiss connectivity is not as good as Indian connectivity.
Indian connectivity. Go on, sir, go on.
So I'm saying that government probably needs some time to wrap its head around how they want to restructure the solar manufacturing. But in the meantime, since we were losing money at this very high rate of nearly 9 crores every month, we thought it was not fair on Indian investors for us to continue to bleed in this manner. And we decided to just, we decided to stop funding them. So the application has actually been made by the German managing director under German law when they see that there's no visibility of funds in the next 2 weeks, and then they must compulsorily file for insolvency, which is what they've done. And so we at this time, there's an interim administrator who's been appointed, and he'll make a report. And then he's going to go back with his recommendations, which might take about 3 months. If in the meantime there is some movement and there is clarity about how the German government is going to support German industry.
Mr. Keruka, if I can just come in, is there like a one-time write-off here? One. Second, can you kickstart this if there is clarity on the positive side?
You see,
Restart rather. Sorry. Go on.
Right. So let's look at it from 2 aspects. One is the technical aspect. Technically, all you have to do is start firing the furnace. You switch on the gas and you switch it on and you're back to production. Technically, that is the story. We have a full complement of workers there who are experts. They know their job and they are very dedicated, strong people. I have a lot of respect for the workforce there. They would be available, I believe, at short notice to resume work should the circumstances allow them to do so. And as I've seen before, the investor is looking at visibility. If the investor sees visibility, there's no shortage of funding. So I suppose that this is going to follow the same pattern. So we do have a 3-month period in which we're going to see what kind of a response the administrator is able to generate. Right now, it's outside our hands, number one. Number two, the clear thing is we've stopped funding this. In future, any demand for any money will go to the German government and not to us. So we have sort of, we have ceased to be responsible for the expenses.
All right. Sir, that point, will that be a one-time that will be seen in one of these quarters? If yes, what could the quantum be?
See, our exposure is 35 million euros altogether. We have funded about 20, out of this was 27 million was funded by us. So the exposure is not something which I can speak about now because we have sizable assets. There's a very large plot of land. There's a very strong construction. There could be other uses to which this property could be put. And there might be customers for the property itself. There are, of course, plant and machinery for which we could be one of the customers, because a lot of it is brand new. So it's not necessary that the entire amount that we've invested will be written off, but this is just something on which I simply cannot make any comment at this time.
Okay. All right. So I think the street views it as a positive that now you can focus on the core India business where you have some protection as well. And the margin difference has been substantial because the entity that we're talking about in Europe is loss-making, while India business is expected to improve from year on. So purely for the India business itself, could you tell us what is the realization difference if I look at it, on an average today in comparison to, say, Q4, very, very roughly? And what kind of a CAGR can you look at on the India revenue from year on and margin trajectory as well. I recall you doing 30%. That came down to mid-teens, but that's expected to improve as well. Please go ahead.
Yes, please. Margins are definitely on the way up. Demand is robust in the country. We are focusing on maximizing production, and we are focusing on
again, we've lost
demand
that line.
and getting ready for that. So the picture here is very positive. Yeah.
Mr. Kheruka, just a...
Are we back?
Yeah,
Yes,
we
sir.
can hear you. Please go on, sir.
You were giving us a number. What kind of revenue CAGR can we look at and margin trajectory from here on for the India business?
The margin trajectory is only going to improve. It should not deteriorate from what I can see. The demand is very robust in our country, and we continue to meet the demands of our customers. So we're looking at a 60% expansion, and this will allow us to devote our full time to this. In the past, we have been devoting time to things that were not productive. And I must take out time to comment about the government. Our own government is very proactive. And when I see the difference,
Mr. Kheruka?
We are headed, yes.
Yeah, sorry. Paucity of time, so just trying to squeeze in one last question. So since the company's filed for bankruptcy, your German subsidiary, you ceased to be promoter immediately, and this was contributing 22% to your revenue. Will that be made up by the India business this year itself? I mean, in the interim, suddenly the 22% is gone, right?
Yeah, the revenue has gone, but the profits have gone up.
Yeah.
To the extent maybe nearly 27 crores per quarter is going to rise. So that revenue was not giving us anything. It was taking it up.
Sure.
They won't lose money on sales now.
And 27 crores of additional profit every quarter. That's an important, of course, something that your shareholders will like.
All right, Mr. Kheruka, we'll leave it there, sir. Good speaking with you on a patchy line, but I think on a firmer line next time you're here. Look forward to our next conversation. Appreciate you joining us here for that chat. We'll take a quick commercial break here. Commodities in focus next, and of course, that chat on the economy with Lata coming up as well.
सपना था कि खुद का
Welcome back. Let's quickly do a roundup of the commodity market headlines this morning. Manisha is here with us. Manisha, fill us in.
Thank you for that, Surbi. I'm looking at the crude oil prices because the previous week wasn't such a great one, and we've started this week as well on a weaker note. And this has led to week-on-week, month-on-month crude oil prices trading into the negative. And in this year, until now, we are 8% in the red as well. Well, the major cue really comes in from the OPEC Plus meeting that happened on Saturday and the kind of statements we heard from therein. So OPEC Plus has accelerated production hikes, citing stable economy, low oil inventories, and sustaining demand in most parts of Asia. What OPEC has done is that it has hiked production by 548,000 barrels per day for the month of August. And the expectation is that this is the number you could be looking at going forward as well. What we saw for the month of May, June and July was 411,000 barrels per day of an increase in production. So you have a big number coming in for the month of August. And this clearly has been rising as we've seen in the previous months as well. So that is what really seems to be bothering the screen. Apart from that, it is OPEC Plus unwinding. Remember, 2.2 million barrels per day. This is over and above what the OPEC and OPEC members have been withholding, looking at the kind of supply that they have been seeing in the global markets there. Well, apart from OPEC, it also has to do with the US tariffs, where the street expects that it would take effect now from 1st of August. That doesn't do very well for many of these industrial commodities with the kind of impact expectations from there. The other is the US finalizing rate amid ongoing negotiations. And the street is also looking at the weak China services activities, surprise build-up in the US inventories. All of those things have continued to weigh onto the markets there. The US crude inventory in this week, if you see a hike, would be an 8th straight week of hike coming in, and that doesn't augur well for the price increase there. What the street will watch out for going forward now, of course, is the FOMC Fed minutes that's going to be released on 9th of July. And apart from that, all the tariff conversations that you will be seeing will impact many of these commodities.
All right, Manisha, thanks very much for that. That's Commodities in Focus. We'll take a quick commercial break here. It's the economy in focus. My colleague Lata will come in for the conversation. And we'll have three top gentlemen joining us, Ajit Chenoy, Raj Kiran Rai, Indranil Pan on that discussion. Coming up in just a bit.